Sanjeev Prasad joins us now. Let's take our conversation forward. Sanjeev, good to have you back. Thank you for joining us. We've seen all emotions of market in this year. Panic crash, disbelief, great comeback, and now excitement and the FOMO effect. What is next? What is in store for Indian markets for 2021?
Well, I just hope it is going to be a lot boring year compared to what we saw in the current calendar year. Obviously it was a bad year in terms of, the lives lost and also livelihoods lost given the severe pandemic. The markets did actually quite well, since markets are forward-looking, and once market got confidence that, the pandemic is going to be a short-lived thing, despite the negative impact of that in the short term. And the market started focusing on the recovery, which played out quite well in the second half of this calendar year and will continue to play out next year. So as you said, we have seen, everything, a big crash in March and a sustained recovery since then on expectations of continued recovery in the economy and earnings. And that's played out, I would say, quite well. We also saw a lot of sector rotations during the course of the year. We had initially people focusing more on the defensive sectors, and as the market got more confidence about overall recovery in the economy, you have seen other sectors also coming back, the more economic sensitive sectors. Next year, I would assume you could expect similar returns to what we have seen in the current year. Maybe low double digits kind of return, assuming economic recovery continues. We don't have any resurgence in the COVID pandemic. Vaccine comes somewhere in the second half as far as India is concerned. And you possibly see some earnings upgrades. If that's the case, then I think expect similar returns compared to what you saw in the current calendar year. Having said that, the recovery next year would be a lot more uniform in the sense, the returns across sectors will be a lot more uniform compared to the very wide divergence that you saw in the current calendar year. You had, 60% return in the pharmaceutical sector and pretty much no return in the banking sector. I suspect, you will see returns converging a little bit around market returns next year.
Okay, I'm just going to, this is for the benefit of our viewers, I'll request my producer to fire the YTD chart for Nifty. Now, we may look at the recovery from the lows and say, voila, what a year it's been from the March low. But frankly, Nifty in last 1 year, which is this year, and in last 3 years has done not exceedingly well. That's the Nifty intraday graph for you guys. Let's look at the YTD graph, please, the year to date, and you will get the picture which I'm trying to, represent here. Okay, there is some issue with the controller is what I've been told. So, Sanjeev, my question is that we may look at markets from the March low and say, okay, it's been a great recovery. But frankly, the Nifty has done nothing extraordinary this year. Are we in for double-digit gains for Nifty for next 2 or 3 years? I mean, could this be a CAGR? Could large cap stocks give a CAGR of early teens or late teen returns now?
If you look at the current calendar year, return is about 11%, CYTD in rupee terms. It's about 8% in dollar terms. It's actually underperformed the global indices. If you look at MSCI World Index, that's up about 11%, and MSCI Emerging Market Index about 13% in dollar terms. So it's been an underperformer as far as this year is concerned. And even last 3 years, it's not been that great a performer. If you look at last 3 years, India's up 16% versus MSCI World Index, which is 26, and MSCI Emerging Market Index, which is 12. So, nothing great in that sense, especially if you look at a CAGR basis, that will be like 5% in dollar terms. My sense is, going forward, assuming, you start seeing earnings coming through as is expected as of now, something like 28% earnings growth is what we are forecasting for FY22, followed by about 17-18% for FY23. Then, market could probably give you double-digit returns. I would say low double-digit returns. With some amount of derating also in the multiples. Keep in mind the fact that the multiples, as far as the broad market is concerned, is fairly high now. If I look at on a March 22 basis, we're already at about almost 22 times as far as Nifty 50 index is concerned. So clearly not much scope of rating. And earning numbers have to now grow into the market with, with the kind of multiples most of the sectors and stocks are trading at. So I guess, the important thing would be whether earning numbers come through or not. And the last 4-5 years have been fairly disappointing as far as overall earning numbers are concerned. We have seen a fair amount of disappointments in the last 3-4 years. Hopefully earning numbers have bottomed out this year, and given some of the reforms being put in place by the government, especially for domestic manufacturing, hopefully some of the headwinds the economy was facing with respect to investment and employment, hopefully that starts to reverse and you start seeing, somewhat more sustained growth in household income growth. That is what will support the economy going forward.
If you believe markets will give double-digit return, will returns come from the original leaders, which is IT, pharma and Reliance, or market returns will come from the current outperformers, which is industrial, cyclicals and banks?
No, as I said, I suspect, next year will be more of a beta year in the sense, everything will probably move in more or less in line with market returns. Given the fact that this year you have seen, recovery every year, everywhere. In the sense, first you saw some strong recovery in the pharmaceutical sector, followed by consumer, IT, and then as the economy started, opening up and the markets started getting more confident about the economic recovery. Just about every sector has come back fairly sharply now. Even though still on a year-to-date basis, we have fairly wide range of performance. My sense is next year will be, as I said, somewhat more uniform returns across sectors, more driven by roll forward in earnings than any great change in multiples, given the fact that most sectors and most stocks now seem to be trading at fair multiples. So I really doubt you would see rating in multiples from where we are. So the way to make money now, I assume, is going to be through roll forward of earnings. So as markets start discounting, calendar 22 or FY23 numbers, in 12 months' time, that's how probably one is going to make money.
Sure. A lot of themes really, Sanjeev, emerging in the market. Of late, you've seen that big PSU reboot take place, be it PSU banks, be it the other PSU stories. They're really coming to the fore. Again, it seems that the government is picking up pace on the entire disinvestment process. And today, of course, we're going to kickstart the expression of interest process as well for BPCL. Do you believe this could be looked at as an investment opportunity, or would you say, it's not done till it's done, wait for the first disinvestment to take place and then take a call on what to do with PSUs?
See, the stocks have become pretty cheap, about 2 months back. And what we are seeing now is, these stocks also participating in the rally and, getting related to some extent. On paper, they will still look cheap. The question is the long-term sustainability of some of these companies, especially which are in, very carbon-intensive sectors. And unfortunately, most of the government companies, if you see, either they are in fossil fuel sectors or, they are PSU banks. So the question is, what is the longer-term story as far as some of these entities are concerned? Do they transition from, the current operating models which they have to something else, in the sense, some of these carbon-heavy companies start focusing more on livables, etc. I don't know. We have not seen any such, announcements or change in plans being announced by the companies or the government. So I assume, these companies could possibly keep on getting derated over time, as the market starts focusing more and more on the longer term prospects of these companies and what is the real terminal value of many of these companies, that's a big question mark. So there could be some excitement from time to time on divestment news, but I suppose the longer term picture of these companies is not that clear, given how they are currently positioned and the question marks around the longer term business models of some of these companies.
Sure. But would you, bifurcate the entire PSU pack from PSU banks in particular, Sanjeev, by any chance? Because the story playing out in PSU banks with the spree of fundraising, with QIPs in process, brokerages turning bullish on SBI, that seems to be a different theme from the rest of the PSUs.
But I guess SBI is in a different league anyway as far as the PSU banks are concerned. But again, some of the smaller banks, what is the end game over here? I'm still not, very clear. Fundraise will definitely help them. But are they, positioned to face the, the banking sector, which will change quite rapidly over the next few years? You could see entry of, more banks coming in. You will see, fintech entities becoming larger over time. You will see, business models of payments and lendings, changing quite dramatically over the next 5 years. How well are these smaller PSU banks positioned to transition? Again, not very clear. Yeah, the fundraise will definitely help in the short term. But again, the challenges around the longer term business models of most of the government companies. I mean, they need to change from the way they have operated in the past, may not be very relevant going forward, given the changes which are happening to the sectors that they operate in. Coal India can produce as much coal as it can over the next 30 years, but is coal going to be relevant, fuel source 30 years down the line? I'm not very clear. So what is the terminal value of many of these companies? That's the question which the government has to ask and see whether the cash flows of some of these companies and the market cap which they have currently can be used, to build more future-proof businesses. Unfortunately, we are not seeing any such transition in that direction. So the market, when I talk to investors, that's the pushback we keep getting constantly, that, many of these companies don't seem to be future-ready. And the business models, may not hold up in the more longer term basis, I'm not talking about the short term everything is okay, but more on a 10-15 year time frame when, renewables becomes an increasingly larger portion of India's energy mix, or in the banking sector, you have a big change in the way banking is done. How well are these companies positioned? That's the question which investors keep asking.
Record a video on his best. Sanjeev, in any market, there are always opportunities where you would say either the stock is fully priced in or the earnings are not likely to go the way markets are anticipating. Where do you think right now markets are pricing in perfection?
I think in most parts of consumer, especially consumer discretionary, I think the market is already pricing in a fair amount of recovery in volumes and sales. I don't know, we'll have to wait and see whether the sustained recovery that we have seen in the second half of the calendar year sustains or not, because that is linked entirely to continued growth in household income. And obviously household incomes have got impacted because of the COVID pandemic. So whether it is consumer appliances or two-wheelers or four-wheelers, some of the demand that you have seen over the last few months could simply be pulled forward of demand. In the case of consumer appliances, for example, it could be for convenience reasons. In the case of two-wheelers, small cars, it could be for personal safety reasons. So how much of that demand sustains, we'll have to wait and see. Multiples on the higher side, clearly factoring in sustained growth in volumes, etc. We'll have to wait and see whether that comes in or not. So if any disappointment, you could see obviously earning numbers getting cut, but also multiples getting derated in many of the consumer discretionary names. Keep in mind the fact that, you had an economy that was slowing down anyway, even before the pandemic. Investment was anyway actually declining, and it had a slowdown in consumption. And I would assume somewhere COVID has had a negative impact on household incomes, right? And it's not as if we have seen a lot of fiscal support coming from the government as far as household income is concerned. So I would be very surprised if, you see consumer discretionary demand surprising on the upside compared to whatever the street has built in. If anything, there could be some downside.
Can hotel stocks, airline stocks, multiplexes, can they be the outlier? I'm just trying to construct a scenario here, Sanjeev, that let's assume that half of the world population is vaccinated in next 8 to 12 months. Then definitely there is going to be a pent-up demand which will come in travel, tourism, restaurant, going out, watching movies. Do you think it makes sense to preempt this kind of a trend?
But I think the market has preempted all these things a long time back. Just look at the way that all the stocks have come back over the last 2-3 months. Your thesis is valid in the sense, obviously, there will be a huge, demand as when people get more confident about going out, assembling in, one place, traveling, etc. But the way the stock prices run up and the fact that many of them are now trading close to their pandemic levels would suggest that the market is already factoring in a pretty steep recovery in volumes as far as some of the sectors are concerned. So the reopening trade is probably done, I would say. Now we have to see whether the reopening trade actually plays out as the market is already anticipated in terms of whether the volume numbers come through expectation FY22 and FY23. So that's the bigger challenge. And as I was saying, given the fact that household incomes have got dented, I don't know whether the recovery will be as strong as what the stock prices seem to be suggesting. Of course, the other part of the stock prices is the cost of capital, and you can use a very low cost of capital, but if you discount cash flows and justify a higher P or EBITDA, whichever way you want to look at it. But we'll have to be a bit careful about extrapolating some of the trends that we are seeing currently. And so we're saying the sustainability of household consumption demand is going to be the most critical thing over the next 6 months, and I guess we'll get a better handle on that over this time frame.
Sanjeev, closing comments really. The construct of the economy is changing in a meaningful manner in favor of large cap companies, whether it is aviation, whether it is telecom, whether it is banking, whether it is even media. How does one understand the positioning of small and mid cap stocks? Every time when we discuss small and mid cap stocks, the argument I get back sometimes is large caps have rallied, now small caps will rally. That is logical when the economy is very broad based, but at a time when permanent shifts have happened in favor of market consolidation and in favor of big companies, do you think mid and small cap stocks, barring some pockets of excitement here and there, are unlikely to come back with a vengeance as a group?
You have to look at companies on a company by company basis. If you have companies which have very distinct business models with very smart management, they are fine. They will be able to grow for a reasonably long period of time. And we have seen that, if you look at, for example, chemicals, you had very small companies 5 years back, but these companies have evolved and become fairly large companies now, from small caps, they have become mid caps. In fact, some of them have become, in fact, large caps to the likes of startup, etc. So as long as you have, business opportunities available, and thankfully, given the fact that penetration of most goods and services in India is so low that, growth opportunity is immense. And if you have, management which are capable of participating in the opportunity which is available, you bet on those particular, business models and management. So I won't, dismiss mid caps, small caps outright, nor I will, simply take a broad brush for all mid caps and small caps. Of course, in sectors which are dominated by large caps, you have to be particularly careful because, as you rightly said, large will become larger. It's Darwinism in its truest form playing out. You will see massive consolidation across sectors. In some cases, you will have probably 1 to max 3 players now, given the winner take all construct of many sectors. So you have to be, again, careful when you're looking at mid caps. Which sectors are they in? What kind of market structure they are operating in? What's the market opportunity like? how well is the company positioned to participate, what's the management like. So you have to do your, usual checks, kick the tires, and then only take a call on mid caps and small caps, But as I said, thankfully in India, you have a large number of exciting, opportunities available in mid caps. Chemicals is just one example. I think we will start seeing several more companies emerging in the domestic manufacturing space. Companies are still very small, but you are seeing fairly interesting companies in precision engineering, etc., which will come up. They're already reasonably large suppliers to larger companies globally. And as the Indian market becomes larger, they will start supplying to the domestic market also. So I think there is enough scope for mid caps to do well, as long as they have a decent business model.
All right. Thanks so much for joining us this morning, Sanjeev. Always a pleasure.